When war breaks out in the Middle East, the first thing most people watch is the battlefield. Because not every asset reacts the same way when a geopolitical crisis turns into an energy shock. Some assets move immediately. Some lag behind. Some look safe until inflation changes the rules. And some only appear strong because investors have nowhere else to hide. Over the past days, markets have already started repricing that map. Oil has surged, at one point nearing $120 a barrel before swinging violently lower and then higher again. Global stocks have struggled. The dollar has strengthened. Safe haven flows have turned toward gold, the Swiss franc, and the Japanese yen. And expectations for interest rate cuts have been pushed back as investors start asking the same old question in a new crisis. What happens if this becomes an inflation shock again? Oil is usually the first asset to react because the Middle East is not just another region in the global economy. It sits on top of one of the most important energy systems in the world, and the Strait of Hormuz remains one of the most dangerous choke points on Earth. When traders believe that tankers may be delayed, rerouted, threatened, or blocked, they do not wait for the shortage to become visible in your neighborhood. They buy the risk first. That is why oil spikes before the full economic damage is visible. The price is not just measuring current supply. It is measuring fear about future supply. It is measuring shipping risk, insurance costs, military escalation, and the possibility that a local war turns into a global energy problem. That is why oil is usually the first winner in a Middle East shock. Not because war is good for the global economy. It is not. But because energy is the transmission belt through which geopolitical fear enters the financial system. Reuters reports that the current crisis has already driven extreme volatility in oil, with major forecasters lifting their assumptions and the IEA describing the present disruption as historically severe. Barclays has warned Brent could test $120 if tensions persist. That is why gold keeps reappearing in moments like this. When oil rises because the world fears disruption, investors begin looking for something outside the chain of promises. Outside corporate earnings. Outside central bank targets. Outside political negotiation. Gold becomes attractive not because it generates cash flow, but because it sits outside the system that is being questioned. In this crisis, Reuters has already reported that investors were seeking shelter in bullion after the US and Israeli strikes on Iran. But the relationship is not always simple. Gold can also come under pressure if the dollar rises too fast, or if investors conclude that higher oil means fewer rate cuts and tighter monetary conditions. That is the paradox of gold in modern markets. It is a haven, but it still trades inside a world dominated by the dollar and by interest rate expectations. If oil shock turns into higher real yields and a stronger dollar, gold can wobble. If the crisis deepens into a broader loss of trust, gold can regain the upper hand. In other words, gold tends to win when the market fears instability more than it fears tighter policy. This may sound strange at first. Why would the currency of a country involved in the crisis become stronger during the crisis? When fear rises, global capital often runs toward liquidity first and safety second. The dollar offers both. It remains the dominant reserve currency, the dominant invoicing currency, and the currency at the center of the deepest capital markets in the world. So even when the shock itself has geopolitical roots, the dollar often strengthens simply because investors still trust the dollar system more than the alternatives in a panic. Reuters has described exactly that pattern in recent days. As oil rose, stocks slipped and the dollar strengthened, while traders sharply reduced expectations for Federal Reserve rate cuts. In a world where higher oil can mean higher inflation and fewer rate cuts, the dollar gets support from both fear and yield. In past crises, government bonds might have absorbed more of the fear. But Reuters notes that sovereign bonds have recently struggled to attract the classic haven flows they once did, because investors are now trading them more on inflation risk, fiscal pressure, and borrowing concerns than on pure defensive appeal. That means a geopolitical shock no longer sends money automatically into every traditional refuge. The market has become more selective. The first losers are often global equities, especially when the energy shock is large enough to threaten growth and pricing stability at the same time. Stocks dislike uncertainty. But they really dislike uncertainty combined with expensive energy. When oil spikes, investors have to rethink margins, consumer spending, freight costs, airline demand, manufacturing expenses, and the path of interest rates. That is why broad equity markets often weaken in the first phase of a Middle East shock. It is not just fear. It is math. Higher input costs hurt profits. Higher inflation makes central banks more cautious. Higher fuel bills weaken consumers. And if all of that happens at once, earnings expectations start falling even before companies report the damage. Reuters has already shown this pattern in the current crisis. Global stocks slipped as oil prices climbed and the dollar firmed, while investors rapidly repriced the path of US monetary policy. Airlines are the classic example. Jet fuel costs rise, routes become uncertain, airspace can close, and demand can soften if the broader economy slows. Reuters noted that airline stocks were among the sectors expected to come under pressure as conflict widened and airspace disruption spread. Shipping-heavy businesses, logistics firms, chemical producers, and parts of industrial manufacturing face a similar problem. Their costs move first, while their pricing power often moves later. A country that depends heavily on imported oil does not just face higher costs. It faces a worsening trade balance, pressure on its currency, imported inflation, and a narrower policy cushion. If that country was already struggling with inflation or slow growth, an oil spike can hit like a second blow. That is why a Middle East conflict is never only about the Middle East. It is also about which economies are fragile enough to absorb higher energy costs the least. For years, many investors wanted Bitcoin to become a true geopolitical hedge, a kind of digital gold that would rally when confidence in the system dropped. But Reuters noted that in the current environment, Bitcoin has not behaved like a clean safe haven. It has fallen rather than absorbing fear, underlining again that in many market panics, crypto still trades more like a risk asset than a crisis shelter. And defensive currencies like the Swiss franc or the yen when investors want an exit from risk without taking on direct commodity exposure. Reuters has reported haven interest in both the franc and the yen as tensions rose. They punish assets that depend on smooth logistics, stable fuel costs, easy central bank pivots, and calm consumers. They reward assets that either benefit directly from scarcity or sit outside the weakest links in the chain. That is why a Middle East war can create strange-looking winners and losers at the same time. Oil can surge while stocks fall. Gold can rise on fear, then wobble under a stronger dollar. The dollar can strengthen even when the United States is deeply involved in the conflict. Bonds can disappoint. Bitcoin can fail the haven test again. And the entire market can start trading not on peace or war, but on one central question. A prolonged energy shock is a macroeconomic event. And once it becomes a macroeconomic event, the winners and losers stop being temporary trades. They become reflections of a new reality: more inflation pressure, less policy flexibility, weaker growth, and a world once again reminded that energy still sits underneath everything. But that when this region destabilizes enough to threaten energy flows, money does not move randomly. And that is exactly why the latest Iran shock matters so much. But the repricing is global.